Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day, how you going? Here we are. We're literally 3 days away from Australia turning up at the polls to vote to see who will be our next Prime Minister, whether it will be consistent and Scott Morrison will stay in the chair with the coalition government in power in Canberra, or there will be a change into the shortened government. And who knows? There's been lots of scuttlebutt, lots of debate, so many articles or TV pieces around how this election will fall. Jury's still out, depending who you listen to or what side of politics you sit. It might be very clear what the outcomes will be, and for others, they're saying it's who knows. There's a lot of swinging voters in this election. Some of the policies are developed by both parties, quite contentious. Some of them are universal, and I think a lot of Australians are going to struggle in making the decisions come this Saturday on where they put their vote. But, you know, this is not a political show. I'm not going to dive too deep into that sort of stuff. What I really want to have a chat about today is preparing property investors for, irrespective of the outcome, what they will do moving forward. If there is a change in government, if a shortened government comes in, they've made it pretty clear what their policies are going to be towards negative gearing and a capital gains tax. So that might change your strategy moving forward. Additionally, should there be continuity in the government and the coalition government under Scott Morrison remains, that might help shape your strategy moving forward as well. And for many, it might just be business as usual. For others, it might be a real kick in the pants to actually start critically looking at how you're going to continue growing your wealth through property. So this is an issue that we're looking at, and I think duty of care on our behalf, but also our intent in shaping this podcast is to make sure that our listeners are as informed as possible to make decisions around investing in property. So what we're going to be doing is a couple of different things. Number one, there's this podcast, and I have a bit of a chat today about how you could be preparing yourself for a change in government or continuity in government, and there's a couple of points we can cover off there. But also, I think it's important once we understand how the coin falls, which side is going to be sitting in Canberra, that we start looking about what you do about it. And on that basis, we're shaping up a really cool initiative, which I'm very excited about. We're going to be doing a live webcast, live stream under Smart Property Investment Live. So it's a relatively new thing for Smart Property Investment, something we're going to be doing a lot more over the time. So we're actually going to be bringing ourselves into your computer or into your phone, wherever you are, to actually join in a conversation and a discussion around what this all means for property investors. So put into your calendar now, stop 11 a.m. on Tuesday, the 28th of May. So that's 11 a.m. Tuesday, 28th of May. It's going to be a live webcast. Really just, it's going to be the big changes impacting your properties after the election. So we're going to be deconstructing what we know subsequent to the vote, trying to get some interpretation and narrative around that, and then hopefully give you some tools or knowledge or arm you with some greater insights or maybe motivation to start shaping the way in which you're going to approach property investing into the future. I'm going to be hosting the live stream with the webcast. I'm going to be joined by a couple of people, including Paul Glossop, who's the director of Pure Property Investor. You may have heard him on the podcast recently. Last got together with him on the 1st of April, and we were chatting about his new book, which is The Surfer's Guide to Property Investor. I've asked him back in the studio so we can have a bit of chat about this 3 days out from the election, and then look to work out what this webcast is going to look like. And this is your opportunity now to actually start thinking about this and start preparing your questions. So you can register for the live webcast now. Just go to smartpropertyinvestment.com.au. You'll see stuff all over the place. Just click on it, register, so you can participate in this conversation and actually tune in and watch this live and actually get involved in the discussion. But Paul, how you going, mate? You well?
I'm very well, mate. Thank you for having me again.
It's good. So that's a bit of a 4 minutes of me rambling on about what we're doing. But you know, you don't get a federal election very often, so it'd be remiss of us at Smart Property Investment not to be putting a lot of oversight on this. And my view, and if you tuned into it probably a week or so ago, I had Ben Kingsley, who you know well, as do I, and we had a pretty good chat around the policy issues potentially coming into play should there be a government change and how that might impact what property investors do. And we had a pretty good conversation around that. So I don't really want to go back over old ground, but things will change if there is a change in government. That's what we know clearly. We don't yet know exactly what's going to happen. So when we know, we'll talk about that on the live webcast, 28th of May, 11 a.m. But what's your sort of sentiments? Your clients right now, are they concerned? Are they nervous? Is there a lot of uncertainty, or are people who are, sophisticated investors or confident investors just marching on irrespective?
Yeah, it's probably the investors who have got to or come to grips with the fact that either way, there's going to be there's going to be something in it for investors in the next few days, as and when this election result's handed down. They're the ones who are out there thinking, well, kind of looking at all things being equal from a policy perspective and where we're going to land from a cutting of CGT exemption, negative gearing being abolished from potentially any existing properties, or alternatively potentially status quo. This is still a depressed market and there's still very, very good buying opportunities right now. One thing that I think people have become more aware of and more cognizant of, though, probably over the last 6 to 12 months, which personally speaking, I think is a very healthy position for investors to start thinking more of, is take tax incentives out of the equation when looking at the viability of an investment. And I think that's made a lot more people start to consider, why is this property the right property for me, as opposed to saying, is there good depreciation? Is there going to be some tax advantages? Because now they're realizing that at the stroke of a pen, every time there's a federal election, this could be something that comes up again. So making sure people consider their cash flow on the numbers. Can they afford to hold it? Is this going to be a long-term growth asset that's going to have scarcity, that's going to have demand, that potentially I can add value to? So we're seeing a lot more investors start to think that way, as opposed to thinking with tax first, property outcome second.
And that's really sage counsel. It's been hijacked, this election, in many ways. A lot of the policy debate around whether there's fear-mongering on both sides of Parliament, or both sides of government, around poor property investors or rich property investors or whoever the property investors are, what will happen to their assets should there be a change in government and changes to capital gains tax concessions and also negative gearing. What you said is right. It's not about the tax outcome. It's not about the tax consequence. And I'll put in inverted comments, people that invest with a tax strategy. This is what this isn't about. This is about ensuring that you're buying good assets, which, irrespective of what happens with tax breaks, tax concessions, tax policy, can still perform well over time. Now, there is some potential outcomes and softening or continued softening to the property market should there be a change in government, and there's a lot of debate around that. Now, some of the numbers that Labor has handed down, they're pretty much saying they've got some very smart researchers gone out there and said, you know what, it's probably not going to matter at all if they do remove negative gearing, that property prices will go down. They said it will impact 0.7% of the whatever. Like, whether or not you believe those numbers, I don't know. And just as a bit of a disclaimer, my comments today, and I imagine yours as well, are not leaning any particular way.
No.
I don't know your politics. You don't know my politics.
Yep.
And I don't want this podcast to be based on what our own perceived ideas of politics. So I'll just put that aside, but I thought I'd say it. So property investors need to know that this might be a wake-up call for them, that stop thinking around tax and tax implications. Yes, it is something that should be considered, but it's not the primary consideration. The consideration is, what is a good asset? And how does it fit in your portfolio? So how do you go about doing that? So these people that you work with, are they going, okay, if it has a good tax outcome, that's an upside benefit, but how do you make sure you're buying the right stuff now?
And this is the key one right now. And I'll give a really good example of a client I spoke to yesterday who's a dentist. He's 31. His wife is late 20s. They have a combined income close to $500,000 a year, very, very robust taxable income, and a long working career ahead of them. Previously, and this is a discussion that we had, is previously that's a scenario where people will think, geez, I pay a lot of tax. I'd like to get some tax breaks in addition to getting a long-term outcome. Yeah, sure. But let's try to think about it. Where does that property fit into your long-term portfolio? And if you take tax incentives out of this equation, the long-term growth is really what we're focusing on. The tax incentives may come, may not come. So ultimately it comes down to saying the fundamentals of what fits your budget, what can you afford to hold? Yes, there are still going to be opportunities for people to say you might lose money on a year in, year out basis based on the holding costs of this particular property. But if you take the tax advantages off the table, are we going to get a viable outcome that's going to lead towards capital growth? And the fundamentals will not change. They will lead towards making sure it's an asset that is going to not necessarily be replicatable in a market over and over and over. So i.e. scarcity. Also thinking about, is there going to be a vacancy rate that's going to fit the cash flow analysis that we really want to see? Is it going to be potentially a property which is going to fit a higher density zoning down the track, so you might be able to then maximize what can happen from this property from a land perspective? All those things. Furthermore, then trying to find where are the right properties at the correct time in the cycle to then enter into building that portfolio. People need to consider that. They need to really go into it and thinking, what can I afford? What is my long-term objective? And ideally, what fits the next piece of my puzzle, whether it's my 10th property, my first property, or am I looking to now exit and potentially downsize? One thing I would say that as an outcome of this election, yes, we don't consider necessarily the tax advantages from a depreciation or a negative gearing consideration as any of our primary focuses when securing a property for clients, whether they're on limited incomes or huge disposable incomes. One thing I would say, though, is that if we do see CGT change from 50% to 25%, that is something that I think people are going to really see the focus. And that's probably for me, if I was to ever look at a rationale as to why there might be some more importance to lock in that property now. And just so the voters are aware, if Labor's policy does go ahead, then they're looking at grandfathering purchases that occur prior to the 1st of January 2020. If you purchase a property prior to that, you're locking in the current policy and the current CGT and the current negative gearing advantages. Take negative gearing off the table, but CGT is proposed to be changed from 50% to 25%. That is potentially a long-term difference for anyone who does choose to buy after January 1st, 2020, that if you're holding a property for 20, 30 years and hypothetically you buy a $500,000 investment, that's worth $1 million in 20 years' time, that's $500,000 in profit. Under new policy, that's $125,000 that goes into your pocket as opposed to $250,000 based on current policy that goes in your pocket without getting touched of any tax. So that is something that won't be realised in our next 3 to 5 years. People will only think about the impact of that in 10, 15, 20 years, which is not necessarily to say it's a good or bad thing, but I just want to make sure that anyone who's buying property or thinking about buying property this year is aware of that part.
It's gone on under the radar a fair bit, the CGT concession. So at the moment, you get a 50% discount under the proposed Labor policy. If it gets passed and they get into power, it's 25%, right? So
correct.
You're losing the share of wallet, right?
Yep.
If you break down the numbers around that, the revenue generated for the government at 25% rather than 50% outweighs the incentives or the benefits that the Labor government will get under the negative gearing changes. Right?
Unequivocally.
It's a big number, right?
Massive.
I don't have it at the top of my head. It's a big number, but all the emphasis has been placed on this negative gearing discussion rather than this CGT stuff. Because people are going right now, negative gearing, that's going to impact me immediately because I'm going to have to be paying more, so negative cash flow, paying more to maintain my property portfolio.
Correct.
Oh, that's only an issue if I realise the value of my property, the equity of my property when I sell, right? So people, well, if I'm not selling, it doesn't really apply to me, right?
And it's true.
You know, and it's true, but it will be a big driver of income for the government should that come into place, for a Labor government should that come into place.
Absolutely. The irony is, though, is that, I mean, you look at the pain and gain reports that come out quarterly by CoreLogic, you look at the average hold time has to be somewhere between 6 or 7 years before someone's turned a profit on average of any Australian property that turns over. So the irony is that this is not going to be anything that's going to fulfill any tax benefits for the federal government of tax receipts, at least for the next 2 full terms and beyond. So you think, well, where's the advantage here? Where is that money going to come into the coffers? The money saved from a negative gearing perspective, not to get political, is not going to necessarily drive that big tax collection. It's probably more what will happen in 10, 15, 20, 30 years if that CGT discount changes. So it's an interesting one because it might change investors' mindsets as well. And this is where we're talking about, is this going to mean less people sell? Because they say, well, if I buy and I'm going to sell and I'm going to incur a massive tax bill, am I better off holding and paying it down and just keeping that property in my portfolio from a cash flow perspective? And it goes back to cash flow.
And therein goes, we're getting political, I guess, but should people sit on their property and not sell property? Now, you need to think about one of the biggest drivers of state-based revenue is stamp duty, right? Which is realised on the transaction of property. Now, if people aren't buying and selling property, that means there is an impact there. So,
correct.
As soon as you tweak or change one part of this ecosystem, everything gets impacted. Everything gets impacted. And hopefully our very smart and intelligent people down in Canberra, whether it's in government or within the public service, so the people who are working, irrespective of who's in power, I'm thinking of Treasury and other regulatory bodies, are looking at this because it is complicated. This is you change a couple of things and you can impact the overall economic direction and prosperity of Australia very, very quickly. And we are a nation, the biggest assets Australians hold is residential property.
By a long way.
it is pretty important. Was it 6.7 or 7 trillion? $7 trillion, right? Twice the size, I think, of equities, maybe even more, and much bigger than our superannuation.
Correct.
It's big, right? So you start messing with this, shit can go wrong.
Massively.
Or shit can go right.
Yep.
You know, and hopefully my intent, yours as well, is that we go the latter, right? I want things going in the right direction. So, you know, it is a very complicated and potentially contentious issue, but it comes back to your point. It's about the asset selection, what you're choosing right now. So negative gearing. So, you know, you want to try and find, as quickly as possible, positively geared property, right? Yes, if it's positively geared, you got to pay tax on it, right? But that's cool. You got to pay tax on the income you generate. And if you change things, it's going to change dynamics in markets and stuff. So who knows, right? And when we get together on the 28th of May, 11 a.m. For that webcast, we can start looking at some of these issues, because at the moment it's all hypothetical. We just don't know. We just don't know. So at least then we're going to know at least a couple of things. Number one, whether we actually have a new parliament, whether we're actually going to get to a point whether it's going to be sitting somewhere in the middle. I don't know. Who knows right now? But we can deal with those facts then. But going back to asset selection, I met with my accountant, Manzarul Khan, who you know, and I talk a lot about him on the show. On my portfolio late last week, I'm just going through, I'm trying to do some new financing, right? So I've got to get all my stuff sorted out. There's about 18 bazillion different returns, trusts and all this sort of stuff, right?
I sympathise.
Yeah, he loves it. He absolutely, my recommendation, get yourself a good property account,
Absolutely.
Right?
They need to love it.
They need to love it. He loves it more than anyone, right? But you're a surfer, you know. You got your what is a surfer's guide to property investment?
Correct.
He's frothing, to use a good surfing term, right? About this market that we're in right now. He's going, Phil, mate, and Munzrul's always on the positive side. Like, you know, most accountants are quite conservative. Munzrul is conservative, he's very conservative accountant, but because he's so focused on property markets, he gives him confidence to make really informed decisions around it. Mate, he's excited about this market we're in right now.
You can't contain him. I've spoken to him numerous times in the last couple of weeks, and
he's excited. He's really, really excited. And you know, what's your view of this market? I'll tell you his sort of assumptions, but how do you see it? Because, you know, softening markets, a lot of uncertainty. Hey.
Yeah, absolutely. And I think, so right now from a property perspective, I'm personally, my portfolio, and if I look at it, say what's good for me is good for people I speak with, and I've built my career as well as my wealth from property almost unequivocally directly. And part of that is to say there is opportunities in certain markets all the time. This has presented probably a bit more of above and beyond opportunity that is out of cycle to how you see markets present as opportunities, or potentially at the top of their market or the bottom of their market. And I treat it right now to say there's a few things working towards Australia's favour, one of which is the fact that money is cheap, fixed rates are getting cheaper, and we will most likely see variable rates getting cheaper in the next 6 to 12 months. So cash flow, previously we're talking 6-7%, 3 or 4 years ago, meant that a property was going to be around about neutral if you had a 20% deposit plus closing costs, holding costs. You probably only need the equivalent of about 5% in 6 months' time to actually be able to hold a property at a cash flow neutral rate for a 10 or 20% deposit. So the beauty about that is it opens up plenty of markets for you to start thinking long term that you can afford to hold, as long as your vacancy rates are good, the fundamentals of that market dynamic are good, and the property you buy is the correct asset. Or furthermore to that, you're looking at certain markets across the country. We're now at affordability rates on all bar Sydney and Melbourne. Across the country, you're at affordability rates below 30% of total average household income you need to service an average mortgage. Those numbers haven't been that way for well over 5 years. And the reason why that's important is that the dynamics and where they see, or where the banks see potentially mortgage stress, is anywhere typically above 33 to 35%. If we look back at the peak, Sydney, Melbourne were well over top end of 30, in some cases 40%. And we're at the point now where we're starting to see a lot more markets where people can actually afford to pay more for property, because yes, wages haven't increased, and noted that that is something that will really allow more people to pay more. However, money's got cheaper, inflation is close to zero. So life is not getting necessarily all that more expensive over the last 3 to 5 years, and property has become more and more affordable over the last 2 or 3 years in addition to money. So if I look at the East Coast, if I look down at parts of Tassie, if I'm looking over on parts, even WA now, there are markets left, right and centre that are starting to look much more attractive than they did 2 or 3 years ago. And that's only going to become more so as we see cheaper money come through, tighter credit restrictions already being implemented by the banks, and that's not necessarily going to change. So the long-term ability for me personally to create wealth through property looks very, very look very, very simple, and it's very easy to understand how that landscape's going to present over the next 5 and 10 years.
It's easy to us because we sort of immerse ourselves in it, but most people are sitting there going, it's the wrong time to invest in property because the markets are stuffed, right? There's uncertainty with the election. There's a lot of uncertainty about bank lending policy, and some people say it's softening a little bit, and there's a greater appetite for banks to lend, particularly around to investors. But that said, there's still a lot of serviceability constraints, right? As a product of regulatory recommendations, as well as the fallout from the Royal Commission, right? So there's a lot of I don't know what's going on, right? And Munzerl would frame all that as what a great opportunity, right? This is when you can actually. He's calling the city market. He's been through a number of cycles. He's calling the city market as the best he's pretty much ever seen to actually get in and realise great value moving forward. Now, let's have a quick chat about Sydney. We'll touch on Melbourne and Brisbane as well, but because you are a buyer's agent, so this is your bread and butter stuff. He was asking me what my strategy is as a property investor. And I spoke on two levels. Number one is that the Smart Property Investment Portfolio, which we chat about on the show, portfolio update. Go and check it out. Just click on the I think it's called Investment in Action on smartpropertyinvestment.com.au. Go and have a look. It's all our portfolio. We love talking about it. And there's also what I do on a personal basis. The Smart Property Investment Portfolio, where for us right now, it's just incubating. It's just moving ahead. We're not doing too much. We're trying to tinker with it and tweak it. And he, I think, himself is looking at maybe some fixed rates right across his portfolio. We had the same discussion around our portfolio, which we've done. We've fixed some stuff. It's some pretty good fixed rate money at the moment, which is good. And I highly recommend go and check out your own portfolio and speak to your broker to see what you can do in that regards, because you can lock in some pretty good rates right now.
Seriously, like we've seen, I've worked with some clients just by looking at what their numbers look like recently, that the amount of savings that sit within people's portfolios that we look at is exponential. It can turn portfolios from negative to positive within a 2-week exercise of just looking at those numbers.
And it can be a bit of a headache to do it, but if you've got a good broker, they can do most of the heavy lifting for you.
That's their job.
Go and do it today. Seriously, go and do it today, because you will realise, you should realise some pretty good gains, right?
Correct.
And even if you can't, at least you've stress tested it, what you got's pretty good, right? So it's good to know. And then what I'm doing on a personal level, I'm like, well, I'm cashing up and I'm going to hit Sydney. I'm going to hit Sydney hard. And one of the reasons why is I've got a lot of exposure in Brizzy. So I see Sydney, the city market, as pretty attractive stuff, particularly the stuff that you like to play in this sort of R3, R4 zoning type thing. This is the future. There's, Sydney will be built out at some point. There's only so much land, and it's exciting. When you consider some of the infrastructure developments, you've got the airport going on out west, Badgerys Creek. How do you read it? Are you looking at Sydney at the moment? Are you dabbling? You're sniffing around?
Yeah, we are. I wouldn't say en masse because it still has to be the correct person to fit it. And you mentioned that your portfolio is pretty top heavy in Brisbane as an example. I know you've got stuff in Melbourne, stuff in Sydney, but then it comes down to how is it balanced from a cash flow perspective, and your cash flow is probably somewhat balanced after you've gone through some pretty good exercises to get your cash and your actual mortgages in check. So you've fixed your cash flow position. So I think you're not going to grab cash flow positive options in the Sydney market, but you're not going to get the same horrible yield levels that people were looking at in 2015-16 when the peak of the market was 60% of all purchases were to investors, and you had all this supply come to the market because properties that were owner-occupied turned into investment property. So I think you're exactly right. The way I see it right now is that the valuable aspects, look, where the other thing that for anyone who's buying in New South Wales is going to see almost guaranteed is that we're probably only a month away from the new financial year or close to, we're going to see the CDC changes come through. And what that means for anyone who's buying in any markets in New South Wales is you're going to see potentially majority of councils adopt the new private certified CDC policy, which is going to mean that properties can get through to council. You can see properties that were still zoned even low density residential now fit the bill for a simple complying development duplex, which means that if anyone holds a property that fits that criteria, and you need to know what that criteria is, but it's really quite simple to figure that out, you're going to be able to see properties that can go from application to approval within 3 weeks and build within 5 weeks and build a duplex within 6 months. So you're going to see opportunities in areas which have got really, really good demand, good fundamentals, and you can actually see some opportunities for people to buy and maybe not develop straight away, but you're going to see these opportunities as R2, R3, R4 zones even potentially.
Let's just quickly go through R1, R2, R3, R4. That's consistent across Australia pretty much, isn't it? It changes a bit,
It
right?
changes in the way it's described, but the fundamentals is the same.
So R1 is low density resi. It's like a house.
R2, R1, yeah. So you're basically talking that is typically 8.5 metres high, 2-storey resi. residential dwelling, which is essentially usually going to be an attached or detached dwelling, but ultimately it's going to be residential.
Okay.
And then you're pushing into the R3 or the equivalents in the Queensland markets, Victorian markets. Every market's got a little bit different differentials or descriptions for that. But then you're talking multi-density. You're typically still talking similar heights. Potentially
You're talking townhouses.
You're talking townhouses, potentially 8.5, potentially up to 12, 13 metres, up to potentially in some cases 15 metres, so 3 stories. And then your R4s is typically going to be 4 stories or above, depending on where and what you're buying. And then it comes down to all the other controls that would sit within that local council. But there's plenty of markets right across the country right now where probably at the point where they're into backfill territory, where if you can be clever about what you're buying, still buy a good owner-occupier centric property with decent fundamentals as well as good yields, but on top of that, trying to get something that's a high density zoned overlay and playing a 10, 15-year game, these are the ones that
somewhere
look attractive.
which has and you can go back in time and look at how zoning changes, and there's a bit of science to it, there's a bit of luck to it, but looking at how you can identify those properties that may have a zoning change at some point in time, because then you get a huge uplift, right?
Massively.
If you do get a zoning change. But there's a fair bit of science and research needs to go.
There is, and unfortunately a lot of it's usually kept behind closed doors until it's too late for most investors.
A lot of yellow envelopes floating around, right? You know, it's,
Look, I'm not insinuating any of that.
I think we've flushed a fair bit of that out of local government.
I'd like to think so as well. I'd like to think so as well. But I think if you get in early in that stage, and there's plenty of options, if I go from Brisbane down to Sydney, down to Victoria and the Melbourne surrounds, even some of the larger regional hubs where are starting to see bigger population growth increases, the Geelongs of the world, Ballarat's up to Newcastle. Newcastle's a classic example of zoning changes. Too late, way too late now for Newcastle if you're looking to get in. But you look at what's changed on the foreshores of that kind of area, you go down to Wollongong and the surrounds, you're starting to see these larger markets which have got 2, 3, 4, 500,000 population. They end up with this issue where they've got no land, or it's far more expensive to build the infrastructure as opposed to at a stroke of a pen change the density and backfill and get people closer to where the hubs are, the schools, the hospitals, the rail, buses, highways, or your transport hubs, etc. And that's really what you've got to consider. And a lot of markets have different dynamics in relation to that, where Melbourne, you can kind of build out to Ballarat almost unequivocally, it can't stop, but it will cost money to build infrastructure. Sydney's probably got a problem in the next 15, 20 years. We've got a mountain range, we've got national parks, we've got oceans, and we've got rivers. We've probably got 15 to 20 years to build out before we have to say there's no more land there. We come back and build in, which is already happening.
Yeah, so Sydney's a game of land banking, really, as an investor, getting good quality assets which wash their face are good assets right now, but have the upside potential for being part of the evolving Sydney story.
Absolutely.
Population growth and land scarcity. What sort of stuff do you like in Melbourne at the moment? Because, Melbourne can go forever.
Yeah.
So it's not really like infrastructure will be the inhibitor for how far out population sort of sprawl happens. But what sort of stuff do you like in Melbourne at the moment?
It's probably the similar stuff that I like in Sydney at the moment. It's the stuff that's sort of sitting in that $400,000 to $800,000 cusp. If you're looking at more of the blue chips, some of the blue chip markets there have been absolutely hammered. Hawthorn, as an example, is close to over 20% reduction.
It's crazy, isn't it?
I mean, you look at those markets, but thought to be bulletproof, and they had a crazy tear for 4 years. But if you're looking at owner occupiers, some of those blue chip markets are becoming extremely affordable. But if you're investing and playing the land banking game, following the train line extensions right out the north, out towards the west, over towards even parts of Leverton and the surrounds there, where those train lines already exist, out towards Altona, Sunshine, they're probably still not quite at the point where I think they've found the bottom yet, because they did have a very, very big growth there and the yields just haven't caught up. But they're the markets long term, which are still going to see, within 25, 30 k's of the CBD, rail corridors already in place, and they're already in the point now where they're fully built out along those corridors, and we've already started to see zoning changes, much smaller parcels of land. You've got townhouses, you've got units that are starting to fulfill those different markets. And Sydney's no different on that light.
Do you still like Brizzy?
Absolutely. Unequivocally. I think probably the best thing that Brisbane's got going towards it is because of the fact that the yields, as well as where it's at in its growth cycle, just hasn't gone through that massive upswing, is that you can afford to hold those assets in a really good point in time in their growth cycle. So the north, probably out towards the Moreton Bay Peninsula, there's plenty of rezoned areas, if we're speaking about those that have already undergone zoning changes only recently, but you're still grabbing them at really good quality owner-occupied properties. 350 to 450 will get you into a very sound property with a half-decent yield of somewhere between high 4s, early 5%, and you've got a piece of land that can actually afford development. Out towards the west of the Greater Ipswich corridor, the larger blocks out there of the 1,000 to 1,500 square metres, you've got opportunity for subdivisions left, right and centre, and they're typically far closer to the original infrastructure that sits there. There's a lot of greenfield space out in the west of Brizzy, which I probably wouldn't want to see too much of that touch. But in particular, the larger blocks on the older properties where you've got adequate site access, where you don't have to get rid of the existing home, plenty of opportunities in those markets.
Okay. Well, as soon as we're going around the grounds, you were pretty heavy in Tassie a few years back. You still down there, or you done?
We are.
Yeah.
A little bit secretive because I'm finding it such a pain for me to get good quality assets in Tassie at the moment, but we definitely are there. We're not in Hobart, I'll put it that way.
It's had its run though, hasn't it, Tassie?
Hobart most certainly has.
Yeah.
And I think anyone who's looking at Hobart is a time where it's probably fully valued. But yields are still very good. Vacancy rates are still sub 1%. So there's not a huge supply issue. So it's not going to fall off a cliff. As much as people want to predict that it's going to go and turn around quickly, it can't. There is too much demand. Prices are probably where they will end up, but you can't all of a sudden just go from that to nothing, or where Sydney and Melbourne and Brisbane. I mean, they're not building skyscrapers. They're not building new estates. It's not happening. So you can't change that very, very quickly. But parts of the northwest, there's definitely better opportunities. And it's similar to where Sydney went through the growth.
Being very cagey, it makes me nervous.
A little bit cagey. I'm never cagey, but I've found it very frustrating over the last few months because I've gone back and forth with a few agents. Well, not necessarily, but I find that I'm trying to hold off to try and get the best outcome for clients, and it's the only time I've found it to be the case. Right. But if I was to go around the grounds further, Perth is starting to become a market, and I'll give an example of a property we secured this week, one of which was a mid 300 purchase. I won't go necessarily directly into the suburb, but you're about 16, 17 Ks from the CBD. Again, rezoned equivalent of R3.
On the water or?
Not on the water.
Okay.
So on the train line, where there's going to be a new train line connection to a separate train line. So basically it's going to be better connected over the next 5 years. But again, about a 22-year-old single-story brick home on just short of 800 square metres can fit 3 properties onto this postage stamp. And it's also going to be about $350 a week rent. So you're talking 5% yield on an asset which is still actually got depreciation, funnily enough, and you're 200 metres walk to a train station, which is going to be 16 Ks to CBD at 350 grand on a very simple asset. There's quite a number of those, which if I rewind maybe 3 or 4 years ago, these are the properties that went from a valuation of 450 down to now we're grabbing it at 350, but vacancy rates went from 5-6% down to where they are now, hovering just below 3%. So the market's starting to find that good time in the dynamic.
Okay. And what about Adelaide, South Australia, anything?
I just personally don't know enough about it, and I haven't seen enough to compel me to get into it over Brisbane. If I was to put it very simply, the dynamics, the price, the yields, as well as what the next 15, 20, 30 years looks like for me, rather than spread us too thin from a knowledge perspective, we just don't have the same level of confidence in that market versus Brisbane.
That's cool. That's right. Well, there's, if you like the Adelaide market, there's some good buyers agents that operate down there. So
absolutely,
to your point, you got to make sure that you the people you're using to help you out with this stuff are really knowledgeable about those markets. So you can't be everything to everyone. So,
no, exactly.
But Brizzy, not Brizzy, Darwin.
Look, it's funny.
Again, don't know.
Well, I was looking at the data, the same data that we're looking at from affordability. Darwin is technically the most affordable market as opposed to what people are earning versus what they're committing to a mortgage. Right now, it's just over 18% of the average household income is committed towards a mortgage. And they've got the highest net yield in the country. So fundamentally, you look at it and you think, this should be a market that we should be thinking this is amazing conditions.
Yeah.
But they had a supply issue probably during their boom of early 2010 to 12, and that kept going through. And unfortunately, the resources boom, and I think the data probably doesn't collect a lot of the FIFOs who are in and out of there, who actually don't necessarily live there. So I think as that demand stabilises and the supply stabilises in there, I think it might be a market in the next 2 or 3 years that will present as good yield straight away. And I don't necessarily think we're going to go through this huge resources boom to throw those prices up unequivocally, but it's definitely cheap.
All right. Good.
And the last one I'll throw in there is probably Canberra, which is still just ticking along.
Well, Canberra always gets forgotten, but
it does. It's performed pretty bloody well.
It's been doing all right, hasn't it? How about Great Keppel Island? How's that going?
I haven't been, mate. I don't have the same kind of...
Norfolk Island. How's Norfolk Island?
Island. Well, they've got a big pine problem as far as I'm aware.
Yeah, there is.
And they've got to watch out for those tall timbers.
Have you been out there?
No.
You can only get around on a golf buggy or something.
Apparently. That's right up your alley, isn't it?
Golf buggies?
You'd probably have someone drive it for you, though.
Of course.
Sitting
It'd
there.
be one of those
Queen waves out the side.
Extended limousine golf buggies, right? Gold-plated rims.
Yeah.
Little beer holders all over the
everywhere.
Place. Anyway. But no, that's good. All right. So we covered a bit of ground there. We're shifted from all the unknowns about the election through to property markets, and I think that's probably set us with some talking points for when we get together on Tuesday, the 28th of May, 11 a.m. for the Smart Property Investment Live webcast, the big changes impacting your properties after the election. Well, at least there'll be some known knowns and some known unknowns and
Absolutely.
some unknown unknowns. Got that all right.
Anything
That's
else
all right.
you can throw in?
Anyway, no, I think that's
good.
it. You know, it's which are all true. You know what?
Yeah.
Anyway, so we'll chat that through. But this is your chance if you're tuning into this. I would imagine there's going to be a lot of people who are going to register, log in and watch the live webcast. But we just don't want people who are watching, we want participants. So there's going to be a mechanism that you can do live comments and questions, and we'll answer them on air as we sit. So please get involved. We want you to get involved. Otherwise, it's going to be me asking questions. And if you listen to this podcast enough, you're probably sick of me talking. I'd rather be the voice of you, the property investor, our community. So make sure you get involved. I reckon what's going to happen is that we're going to end up with so many questions that we're not going to be able to answer them.
Potentially.
But,
There's a few podcasts
if it
on the
works,
back of it.
we can do some more around it. So remember, Tuesday, 28th of May, 11 a.m. Go to smartpropertyinvestment.com.au right now, register, and then you'll make sure that you get the notifications when it's happening. It's really, really easy stuff, all very cool. I heard an advert before we started recording today. You're advertising now on the Smart Property Investment Show.
Well, we're giving away our book, so I'm not really paying or making money out of it because I'm actually going to be giving away my best-selling book, A Surfer's Guide to Property Investment.
It's a best-selling book
it's
now,
best-selling. Well, you would have heard the advert, right? So if anyone does want to grab...
So you sold more than one book then, isn't that what you need now to be a bestseller?
Well, yeah. Well, I don't write the definitions.
Yeah.
I just take the claims.
All right.
You know? but I will say that we
Have
do...
you updated your LinkedIn profile to say you're a best-selling author?
I actually haven't yet, but I will. So mark my words straight after this podcast.
Well, I saw you on Sunrise the other day. What's all that about?
Oh well, look, people want to track the story and track the book. I think people can.
Are you a celebrity now?
Not necessarily.
No?
Maybe let's go. What's below D grade?
Oh, I don't know.
I know you could just follow the alphabet, but I
Are
think
you,
it goes.
are you
before
rocking
that.
up at restaurants now in Cronulla as an influencer saying, "Oh, give me a free feed"? And
Reserved seat. No one sits in the seats. Yeah,
Mr.
exactly.
Glossop, you're here as your
Yeah,
normal
I paddle
table.
out the back of the lineup. Everyone parts the ways.
Is that what you get? Is
Yeah,
that the benefits
I get
now?
preferential
You get preferential
treatment. Yeah,
You can
absolutely.
paddle on the inside. No one gives you a hard time.
No one. No drop-ins.
Now, how's it all going?
No, it is. It's funny because I get some calls to the office now, especially over the last few weeks since the book's only gone live. Call it 6 or 7 weeks ago.
Because we did on the 1st of April, right? When
and that was basically
that.
launched the start of April.
Yeah, okay.
And it's been amazing the amount of calls and meetings I've had with people who've just bought the book and said, I went through it, I love it, it just makes sense to me, and it's not that complicated and there's no jargon in there. I think people resonate the fact that I'm not here to proclaim that everyone needs 100 properties or needs to become a gazillionaire by age 30. It's more along the lines of trying to figure out what on earth you really want to do from a financial perspective and what's going to make you happy, and then filtering in all the property different vehicles, strategies, ways you can do it to try and fit what you're after as opposed to what everyone's trying to aspire to. And I think in the day and age of social media and everyone's just looking at the people who are ultimately living potentially a false life or their best life or whatever it looks like, people can resonate a lot more with the fact that it's not about trying to compete or keep up with the Joneses or try to get my next sports car or waterfront property. It's just about trying to figure out what makes me happy and then build a plan to fit that.
All right, fair enough.
So yeah, we've still got, and we're running that for your audience. So if people jump onto our Facebook page, Pure Property Investment Facebook page, they just hit the message button there. If they just type Smart Property in there, it'll take them straight to getting a free book. So we're actually offering that to all your listeners.
You do all that sort of stuff.
We'll send it out. So my team at the back I think we've got a limited amount of books. I don't know how much are there now. I know they've been running out pretty quickly, but they're there and we'll post them out.
You've got a warehouse in Cronulla filled out, is it? Forklift trucks driving around with pallets of books, is there?
Mania, absolute mania back there.
Oh, okay. That's enough of that. Anyway. Thanks, mate. We'll see you on the 28th of May, 11 a.m. Go and register. If you have any problems with that, send us a note on smartpropertyinvestment.com.au and make sure that you are registered. But we're going to get right into it. We're going to have Paul, obviously, on the panel, another couple of people, and we're going to keep it pretty relaxed. Get involved, send us your questions, and, contest us as well, challenge us. So we're happy to take anything that comes down the line. So that's smartpropertyinvestment.com.au. That's probably enough for today. I don't want to bamboozle you with too much information. Just remember Smart Property HQ if that's how you like to get your info via social media. If you like what we're doing with this thing, remember, just click on the subscribe button wherever you listen to this podcast so you're the first to know when every new podcast episode comes down line. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.